What's up, everybody? Michael Silva here. What if I'm wrong about what's going on in this stock market? What if the market continues to just press higher and higher and we never see a red day again? Seems unlikely, but hey, it feels like that right now, doesn't it? As we're getting squeezed. Did you survive the short squeeze? As we discussed in prior video. But what if I'm wrong about, more specifically, where we land in this business cycle? This is a great illustration. If you want to screenshot that and read it over. But really quickly, let's decide what stage we're in. Well, first and foremost, we can cross out 3, 4, and 5. Why? Well, if you look here, all those stages include commodities going up. So let's take a look at commodities right now on a 1-month basis, 3-month basis, 52-week change, and year to date. I highlighted the 1-month change because that's the most recent. They are stacked ranked from the worst performers up top to the better performers down towards the bottom. You can see here lumber, which is a big one to watch. It is massively in the red and it continues to get hit. And more, over half the list of commodities here are all in the red. It's not until we get over here, which, they're slightly in the green for the most part, which could very well change in the near future. Other than natural gas has been perpetuating itself significantly higher. Now, if we take a look at oil, this is a huge component to the CRB index. And as you can see here today, well, we cracked significantly lower, 3.98%, and we're cracking out of this potentially area of distribution, right? We have a stage 1, stage 2 markup, stage 3, which is wild distribution, and then we could be going into a stage 4 decline. We'll see here if it comes intact as 85. That's going to be a key level as there was resistance there. But that's not the only one. Let's take a look at a massive commodity, copper. Dr. Copper, it's known as, which is a great indicator of the economy. And you can see here today it was down 1.46%. So it is not participating in the stock market rally. Commodities are getting hit, and this has seen a massive fall to the downside, and it's catching a little bit of a bid here, and now we're starting to see a couple days of weakness. So we got to continue to monitor and see how this develops. Okay, now the next thing that I want to pay attention to, we talked about stage 3, 4, 5 being out because commodities have not gone up, sorry. Let's talk about bonds, right? So stage 1, bonds go up. Stage 2, bonds go up. In stage 6, actually, bonds are going down. So where do bonds lie right now? Well, first and foremost, let's take a look at the yield curve. We talk about this pretty frequently. It is now at minus 37 basis points. This thing continues to perpetuate to the downside. You do not want that, right? What is the bond market telling you about the future of our economy? Well, it's basically saying its growth outlook is not all too well, right? This needs to start turning up and heading out of this inversion for maybe the growth outlook to be a little bit better. But clearly, we are heading basically flat on our faces right here, just straight down. And you can see down below is the SPY. It is just not participating. It's completely ignoring the S&P 500 rally. And that's not just the 10 and 2 curve, the 10-year and 3-month, more of the Fed staple. This one is now a 21 basis point, so it's not inverted, but as you can see, it's been falling flat on its face too as well. And you see up here multiple curves that are just compressing and going into inversion. If you just take a look at, the 7 years at 2.8, the 2 years at 3.1, and so forth down the list. If you want to look deeper into that, you can just screenshot it and look. Okay, so we have that. And then if we take a look at TLT, we discussed this. Not the greatest place to buy right here as we hit at the beginning of the week at the top end of the range. The very next day, we sold off. We said, okay, maybe we get a pullback to the 20 or 50-day moving average. We got a pullback to just about the 20-day moving average. And look where the market finished up on bonds. So the bonds finished up 1.57%, which actually matched the performance of the S&P 500, which to me sounds a little bit of a risk off despite this big squeeze going on. However, are bonds actually going up yet? And the answer is no. They're not really going up at this particular point in time. If you just look back to May, it is relatively flat. Now, this could be building out a base or an inverse head and shoulders, right? That could perpetuate this to significantly higher, just ripping higher, which could be a risk-off environment. And if that is the case, well, let's go back to this screen. So if we say that bonds aren't really going down, but they're not quite going up, right? Stocks our stock. Then we got to go kind of look at stocks, right? So right now, bonds, I would kind of cross this out. They're moving up slightly, but overall in a neutral phase. And then over here, we got to discuss, okay, if bonds aren't going up, they're in a neutral phase. It's debatable. Our stocks, what's the next one? We got to talk about stocks. Okay, so are stocks going up? Well, it sure seems like stocks are going up at this particular point in time. Let's take a look at the big mega caps, which really drove the market today forward. Apple is at 3.82% up on the day, but it is tagging that upper weekly expected move. Microsoft was up 2.78%, but clearly it's still in a downtrend below that 200-day moving average. All right, we continue on. Google, it's been going in a sideways trading range. Now it's about to hit the upper range there, right at about 120, which is also the weekly expected move, to a low of about 105. So this has just been chopping around. It has not been going up, and this is a mega cap stock. All of these that we're going to talk about are mega cap stocks. Amazon did see a big move up. However, it is below that 200-day moving average, so it's going up in the near term. It was up 4% today. But remember, we haven't even seen a digestion of this move at this particular point in time. So this still remains in a downtrend, but in the short term, we're getting a press higher. If you take a look at NVIDIA has been going down, but now we're starting to base out here as it's hitting its upper weekly expected move. So yeah, in the very short term, it's going up. But if you just look back across the screen to the left, pretty much the entire year, it's been down, and it is down pretty significantly, all right? And that's a big one too. Tesla, it's still down on the year as well, but we are starting to get a big rip. Now, this is just coming out of a compression pattern, getting that earnings, came up, back test, now we're right at about that upper weekly expected move two, trading just at about that 200-day moving average. And this was up 2.27% today. All the mega cap stocks were really up, pressing the market a lot higher. Okay, so if we go back to this, it's kind of, up in the air. Are stocks going up? I mean, in the short term, yes. But actually, for the year to date, stocks are really going down. And remember, business cycles take a long time. So we can't just look at 1 or 2 days and decide, hey, stocks are going up at this particular point in time. The trend still remains down. However, we are starting to see some strength come in. All right. So what does that put us at? Well, I mean, if we look at this, it really kind of puts us into two areas, right? Stage 1 and stage 6. Stage 1 is still within a contractionary phase. Stage 6 is actually technically still in an expansion phase. And if you look at ISM data, technically we are still within that expansionary phase. So let's read into this. Stage 6 marks a deterioration in the economy as the business cycle prepares to move from an expansion to a contraction. So it is preparing to move itself into a contractionary phase. Remember, inflation's hot. The Fed is raising into a slowdown that we can clearly see. Commodities are coming off hard and fast. It doesn't look good. It looks like we're right now, if I were to guess, in a stage 6. So what can potentially bring us to a stage 1? Well, stage 1 is when we start seeing the contraction significantly, or it's actually, people start talking probably more about it. But this shows that the economy is contracting. Bonds are turning up as interest rates decline. So economic weakness, and by the way, we are starting to see interest rates, come off. If we look at like the 10-year yield, those are coming off slightly. As far as right now, the Fed is continuing to raise rates, right? So we'll see here if they're going to pivot and slow it down, and see how, what takes off from there. But it shows the economy contracting and bonds turning up as interest rates decline. Economic weakness favors loose monetary policy and lowering of interest rates, which is bullish for bonds. Now, we're in a tightening cycle, right? So this really does put us in my opinion, stage 6 of the business cycle. And this is where bonds, stocks, commodities go down. However, if you watch my prior videos, it is looking like, and even this video, bonds are setting up, but you have to be very tactical in this environment. So what if I'm wrong? Well, guess what? We need to watch how the market digests this squeeze. And it is a short squeeze. It is 100% a short squeeze. How do I know this? Well, just run a quick scan on FinViz for stocks mid cap and higher that are, have a 15% or more short float. And look at today's performance. This is stacked from highest volume to lowest volume over here. This is just the first 2 pages. There's only 3 stocks that were down, and they were hardly down. 1.51%, 1.12, and 0.5%. Everything else was significantly up on the day. This is 100% a short squeeze, and it's going to be interesting to see who blows up during this kind of this short squeeze, because there could still be a higher a higher level that we go to with this, right? Short squeezes can get pretty intense, as we've noticed in the past. But what do we have coming up on the agenda coming up this following week and the week leading up to the 18th? So a couple of weeks here of data and calendar stuff that we got going on. The big ones to pay attention to: unemployment rate, non-farm payrolls. That's on the 5th, Friday. Okay, that could shake up the market. Then the following week we have core inflation, just inflation data, and PPI there too as well on the August 11th. And we have sentiment. So we have a lot of interesting data to come out. Now, I've talked about this in prior videos. This chart might look familiar. Now, this is new. I just added this, but this might look familiar. And take a look here, okay? This is like the market sending us a cheat code almost. And I'll explain what I mean by that. But I remember when the market was digesting this move and going through this short squeeze, and I put this up to show everybody that, hey, we have a lot of information coming out here soon, so just be on the lookout. And the market started going sideways. A lot of open interest started building. We had the non-farm payrolls, unemployment, ISM non-manufacturing PMI coming out. Then we had CPI and PPI. And during that time when CPI came out, remember how the market sold off hard? It's like somebody leaked the data and then it followed through to the downside on the day of the report. And then PPI came out. It still continued to move. This was VIX expiration and triple witching. Now, what's very similar here is we're coming into the same type of data, right? We have non-farm payrolls coming out, employment, that's on Friday. The following week, we have CPI, PPI, and then after that, we have FOMC minutes. Okay, now what do I mean by like a cheat code? Well, this is what I find so funny, or interesting at least. Take a look here. This right here was the squeeze going up to this kind of where we are right now, right? We have this area of resistance, and that's where the market kind of is stopping and stalling out a little bit. Well, take a look. 1, 2, 3 up days, 2 down days, and then a squeeze, right? 1, 2, 3 up days, 2 down days, and we're getting that squeeze. Does that mean it's going to play out the same way? No, absolutely not. But it is interesting that the squeeze was very, very similar. How similar? Well, just take a look here at the data, right? This is how today performed, right, on the squeeze day. And then this is how the last squeeze day performed, which was, I believe, June 2nd. And I talked about this actually specifically on my June 2nd video that I posted. And this is where I got the screenshot from. But take a look here at the green and the red. Green and the red, those are the 11 sectors. Energy was the laggard today, down 2.87%. And guess what? Same day on that squeeze, energy was the only laggard, only one in the red. What led that squeeze? Well, we had technology, consumer discretionary, communication services, discretionary, tech, and communication services and materials is up there too as well. Just take a look here too at the numbers on the squeeze. This is just interesting stuff. So 416 on the Dow today, 435 then. 63 on the S&P 500, 75. These are really close numbers and close in percentage-wise too. And then you can take a look at like the S&P, sorry, not the S&P 100. The NASDAQ 100 was up 344 points versus 351 points. So huge moves in the market heading into these interesting reports that we just previously discussed. Okay. Does that mean anything specific? No, it doesn't mean anything really specific, but it is interesting data, and I just wanted to present it with you. Let's hop into the charts before we get into a couple additional key elements about what if it is that I'm wrong. Well, let's take a look here. The market, as I've already stated, hasn't digested the move yet. So the market continues to perpetuate up. What does that mean? We're above that 5-day inclining moving average. That means the market's still within bullish context. The negative divergence continues to hold there on the RSI and the PMO. This is for the SPY on the 65-minute time frame. I'm doing that so I can see more data and see the candles a little bit more clearly. And then if you want to use the 5-day moving average, you mark it as a 30-day or 30 period moving average on the 65-minute time frame. That will equal the 5-day moving average. Okay, so how did today turn out? Well, it was a big squeeze day, like we said, right? It was led by mega cap, gapped up, ripped up higher, and we're not too far off from the weekly expected move. I think that that's a possibility to hit still, so we got to keep in mind that. Now, what I find interesting is if you look back right to the left, very similar. We had the squeeze day. That right there is the squeeze day. Then we had a gap down, tried to get back above it and couldn't quite do it. Went down sideways before, really falling off a cliff. Is that what's going to happen this time? I doubt it's going to be the same situation. Who knows at this point, but we got to be patient and look for various setups, which I'll get into more towards the end of this video. If you take a look at the Qs, Qs are just about tagging its upper weekly risk range, as we're seeing a lot of the mega caps do very similar. It's presenting itself very similarly. They're reaching up to those high levels, which tells me if the Qs start backing off, the mega cap starts backing off, it's going to be hard for the SPY to continue to perpetuate to the upside. Why did the SPY struggle today? The SPY struggled today because of the energy sector. And if you look what makes up the energy sector, you'll see stuff like XOM, right? So these are big mega cap names now after they've ran up this entire year. Energy names went up, so now they're a stronger hold on the overall S&P 500 as their mega caps grow. Okay, so if energy continues to perpetuate to the downside, the S&P 500 is also going to suppress there slightly too as well. So we'll see here what takes on, but as it stands right now, yeah, I mean, if we get more outside of this, you can do intraday shorts back to the upper risk range not risk range, the upper expected move over here. That's always a possibility. I would say that watch to see if it starts getting up to that 327.50, right around where this prior peak was, 327.50, 328. That could mark a great area, especially in an extended move to fade the market. Now, if you're not familiar with shorting, that would be a place where you can potentially take profits. All right, you don't want to FOMO at these levels, despite it continuing to perpetuate up. Right, do not throw caution to the wind, as many people are at this particular point in time. The call buying was absolutely ridiculous today. All right, if we go to look at the IWM is still wedging, very similar to how it did here in June as well, on a negative divergence, still diverging here too as well on the PMO. So we'll see what takes off there. I would like to see it perpetuate a little bit higher and hit this weekly move without digesting. I want to see a very strong hit up there. That would, I feel a little bit more confident adding to to fade the market at that point. But we'll continue to watch it, right? If you're trying to fade, I like to do it at, more extended levels. The market's already made a big move. Very similar to over here. We need to see the price action get back below the 5-day moving average and start to curl over to be more bearish. As it stands on all these index products, we are above those 5-day moving averages. They're still inclining, so the bulls still have control at this given time. So there will be, pivots, right? Like hits to the downside and potentially still moves to the upside. Okay, that means that people are buying the dip until that buying exhausts itself is when we could see the market potentially start to head lower. And that, as of right now, has not happened. So the levels that I'm watching are those upper weekly expected moves, and on the IWM, I'm just watching, and the other various index products, I'm watching the 5-day moving average very closely. One thing that I forgot to mention on the prior episode, maybe I mentioned it, but I have a short on XLF, and I continue to trade around that position. And the way that I do that is very similar to what I'm saying out here. I'm looking at the 5-day moving average. The other day, I added 50 basis points up on a strong move, and then it came back down and tagged the 5-day moving average. I covered that move, and now we're starting to move higher, and I'm looking to add back to the position. This is trading around a core position. If we continue on, look at a couple indicators. Let's look at the NAMO, right? We showed this one yesterday, still negative divergence there, still wedging at this particular point in time. Gonna see how this market digests this move. It will digest it. It's not gonna go like this. It will not just go straight up. It will have to consolidate, pull back, digest, it's going to have to do something where people take profits, and that will happen at some point. So we got to continue to monitor and see when that happens. The NDX, the Nasdaq 100 BP chart, it's still not overbought. All the other ones are still overbought, the ones that I showed you, but there is a subtle negative divergence building right here. Something to watch. A couple indicators that I haven't shown for a while is the NIAD. This is the advanced decline line for the New York Stock Exchange. I remember showing this a while ago during the process of this breaking down, during the process of all this distribution. And right now, as it stands, RSI is getting back to overbought territory and above, or just about to the upper range of the Bollinger Band. Okay, when it did that prior, you can see these red dots, right? You can see them right here, boom. And then it happened also right here too as well. And you can see the advanced decline line went a little too hot, too heavy, and it started pulling back right here. It started pulling back right here. Is it going to pull back, some right here, or consolidate, digest? It's likely. It's happened the last 3 times that this has occurred. If you look at advanced decline volume line for the New York Stock Exchange, very same situation here. It's getting into that overbought territory. It's not quite at the high RSI, but it wasn't quite high here, and it was right here. But you can see it was at the top of the market, right around the top of the market, or sorry, this was the top of the advanced decline line for the volume of the market. And as it was heading down, the market was perpetuating up. That was a negative divergence. And you can see here, boom, it tagged the upper trend line, and then we started to go off. And then right here, same thing. We're going into that 200-day moving average above the Bollinger Band, getting overextended up to the trend line, and we're right here too, where we could potentially, start to see it back off a little bit. Is always a possibility. Another big one to watch is the dollar. The dollar is still within this flagging pattern, and if this does start to break out, watch out, because that's going to put pressure on the markets. That would be a risk-off type move, as we've seen those negative correlations. Not going to dig too much into that one. All right, if we take a quick look at the zones, this is something that I publish for my patrons, and every once in a while I'll show it up on here. If you're not part of the Patreon group, $9 a month, 16% off if you just pay if you don't want to do a monthly subscription. Although, I don't do returns on the annual stuff. So if you want to try it out, do the nine. It's always good to do it at the beginning of the month, because Patreon always charges on the first. It doesn't matter where you buy it. So if you buy it at the last day of the month, you're going to also get charged on the first. Not too sure why they do that, but that's just how they bill. I give swing trade setups, all this stuff down here. And then if you don't have a Discord or aren't familiar with it, maybe this isn't for you, because I post everything on the Discord, and I have instructions how to set it up and stuff with a little welcome message and video. Actually, if you go to the link, I actually made that viewable in public, the post itself on how to set it up, and then also the getting started video where it kind of walks you through what it is that I got going on over here. Okay, so, and I'm going to show you some of the charts and some of the trade ideas here, because the whole video is kind of tailored around, hey, what if I'm wrong? Well, I'm going to show you what I've been doing and get more into detail. But if we look at the zones, this just helps us manage risk, see where risk might be to the upside, to the downside, and so forth. I wanted to call out the dollar, and I added the midpoint in here. The dollar, actually, for the first time in 12 days, 106.48, closed above the midpoint. So that is, I find, pretty interesting. It's been holding as a level of resistance multiple times, and now it is finally trading above the mid zone. So we'll see if something changes there. Other than that, not too much standing out across the board. We have HYG getting a little extended. It's 2% up, or 1.7% upside to 3% downside. ORC also was 2.3% upside of the zone to 12% to the downside. Thought that was pretty impressive. If we take a look at the Qs, that's also getting pretty extended, right? Every time we talk about these overextended, it doesn't mean that it's going to drop 9% or it's going to go up 2%, but it's giving you a good idea as to where the risk is within these zones. So let's continue on back to the whole subject where what if I'm wrong? Well, a lot of people assume that when I'm talking about overextended areas, that the only thing that I do is short the market. And that is where, if you're in part of the Patreon, or if you even follow me on Twitter, that's where most people get it a little bit incorrect. I still play long, and what I'm noticing is a lot of good long setups. So I'm showing a couple just so you get an idea of what it looks like. This was CPNG, right? This little bull flag that was forming. Sometimes I draw, risk to reward levels. It's always about managing risk, right? Having small risk to relatively good size reward, and you manage it as the trade happens. But here's the update there, right? So it broke out at 17, and now it's trading up around almost 19. Actually, it's trading above 19, so pretty strong move there. Today it was up 4.68%. And these are the type of moves that I say, okay, now, you don't want this big risk pocket here given what the market conditions. So you want to update your risk, take some profits, do what you have to do in order to succeed. Here is PTCT. This was part of my watch list that I sent out, and I also put in a trade idea, but it was also flagging. And BOW, we saw a nice big move out of that. These are all long setups. So the reason why I'm showing you this is it's not to brag by any means. Here's Wing. This I showed where it's kind of coming out of this base, and then it pinged right here, and it was kind of just floating below this pivot. And just take a look where this thing shot off to, right? 95, and now it's trading up to about 130. Once again, I don't show this to say ha, here we go, to brag, but you got to understand, if you're wrong about one thing, it doesn't mean that you can't be right about another. I personally like trading from the long perspective, but I do it very tactically from the short perspective. And what I mean by that is, if I have a full size position, say let's take 10% from a long perspective, the most I'll go on a short position is half of that, and I build into those positions and I trade around it. So yes, the market is, bullish in the short term, but it's getting extended. It's getting frothy. I don't believe it as of right now, but that's not going to stop me from looking at very good setups in the market, because there are some. For example, this one right here, I think, and then, by the way, I'll show you a loser too, because I post losers all the time. However, you're not supposed to take these. Well, you can take them however you want, but this right here was, a bullish Darvis box right over here forming, and it looked pretty strong, but, you could either play the breakout or build into a position, but then you need a tight stop if it breaks down. And look at, where did this happen to go? It just broke down today from this, and earnings is coming up too. And this broke down on some pretty strong volume. So yeah, obviously be careful, right? But it didn't ever crack the top pivot line, which is where I typically like to make my entries. And then I also shared a few on Twitter, right? So I posted Sweet Greens. This thing shot up from, 16. Now it's trading almost to, I don't know where that's at, 19 something. So that was a huge move. It was up almost 10% today. And then I shared Cocoa too. This was somewhat of a funny joke, but also the chart looked pretty darn good. You can see here is this rounding bottom. Price was tightening up right over here, and we saw a nice big pop today. Now it's going to that $13 pivot line. So this is where you tighten up risk or take some profits right here, and then see how the move digests and potentially breaks through that, which is pretty cool because consumer staple products do look pretty strong. There's also another one. I'll just say what it is. I'm looking at Monster too. I need a crack of 100 in order to feel a little bit more confident about that one. But yeah. What if I'm wrong, right? So what if I'm wrong? Well, who cares, right? It doesn't matter if you're wrong or right. This is concluding my thought process here. It does not matter if you are wrong or right. What matters is that you tactically approach this market and you manage your risk effectively, right? You can take 5 out of 10. You can take 10 out of 10 trades, and 5 of those be losers, but yet you can still be profitable. You need to manage risk. You need to cut losers when they're going against you, and when the winners are going up against you, you want to let them run, but you got to manage risk along that way. So I hope that gives some more insight into what it is that I'm looking at. Right? So some like I said, sometimes people could think that I'm overly bearish, and that's whatever the case, but I'm not. I'm not overly bearish. I want to be bullish. I don't want to chase these big run-ups, but I do look for positive setups, very similar to this, and I share that with the community. That's all I got with you, everybody. See you later.